Hey everybody, it's John King, and it is Friday, the 3rd of October. Thank you for joining me for my weekly market updates. Unfortunately, my computer feels like it's being a little laggy. I hope it isn't coming across on your guys' side, but if it is, we're going to power through, and hopefully everything is just fine. So we are on day 3 of a federal government shutdown, and it is exacerbating the issues that we're dealing with already of housing market uncertainty in 2025. As I look back over the last 9 months, that's really been what we've been dealing with. A lot of uncertainty, a lot of ups and downs, a lot of just not sure what direction things are going. And I feel like that's getting even worse. Now, in a shifting environment, when things are going to shift from one direction to another, that shift feels very uncertain. So this is typical. This is expected if we're actually making a shift. We've been in an environment where interest rates have been increasing. Housing prices have been reasonably stable. Now we're shifting into an environment where theoretically interest rates are coming down, but we're also seeing housing prices kind of coming down. We're seeing a shift in the number of sellers that are willing to sell. And we're seeing a shift in the number of buyers that are willing to buy. And it really is making 2025 feel extremely uncertain. I've had more and more conversations with people about, hey, I'm just not sure what to do. Whether you are a first-time home buyer and you're not sure if it's the right time to buy, whether you're a current homeowner and you're not sure it's the right time to refinance, whether you are just looking at the job market and saying, I'm not sure how confident I am in the economy of me. It is an environment full of uncertainty. And this shutdown that has started 48, 72 hours ago, 3 days ago, we're on day 3, is creating even more uncertainty. It's putting us into a position where we don't have the data we would normally have. My broadcast today should have been about the jobs market, but the jobs report is on hold because the federal government isn't operating. They aren't putting that report out. So the single most important economic report right now for the state of the mortgage market, the housing market, and potentially the economy, and specifically about the Fed and what they're going to do, was supposed to be delivered today. And it's not. And it wasn't delivered specifically because the federal government has shut down. Now, you know me, I don't get political. I don't care what your political side is, whether you agree or disagree with it. I don't care. The fact is the government is shut down and we're not getting data we're supposed to have, which means the traders, the market is trading on emotion, which is funny because that's really how home buyers buy and sell all the time, is on emotion. People actually make the wrong decisions when they're operating on emotion, because when everything is going good, let's use an example here of buying in the stock market. If the stock market is going up and everybody's making money on the stock market and you feel good about the stock market, your feelings say, well, it's good to be in the stock market because look at all the money I've made. And so you want to buy more. You feel good about it. Statistically, that's the worst time to buy because the market is high. It's more likely to come back down. The idea is buy low, sell high. When prices are low, that's when you should be buying. But if you go off emotion says, oh my gosh, prices have been dropping and dropping and dropping. I shouldn't buy because if I buy, they might drop further. But the truth is, if they've been dropping, then the most likely direction they're going to go after a period of time is back up. Okay. The average goes back to the mean, to the middle of the extremes. And so when you're on either extreme, if things are really, really good, you feel good, but you're making the wrong decision because when the market's really high, you actually should be pulling back some. When the market's really low, you should be digging in deeper and buying more, as a stock market example. And so the problem is we go the wrong direction based on emotion, and we have to use factual information. And right now, the federal government has shut their eyes and said, I'm not releasing any factual information. And so the markets are now trading based on emotion, what they think is going to happen. And the number one emotional driver for people is what? It's a 4-letter word: fear. Fear. Fear drives more decisions when you're thinking emotionally. The fear of making the wrong decision, the fear of making a mistake, the fear of doing the wrong thing. Fear paralyzes people when they think about locking in interest rates. It paralyzes people when they think about whether you're going to buy a home or not, whether you should sell your home or not. The truth is you have to make decisions based upon what is the reality of your situation and understand that nobody can ever time it perfectly. Nobody can time it perfectly. So you have to make those decisions. And right now, the federal government has stopped providing the information that we need. The inflation report is on hold. So we're not going to get the inflation data until the government's back up and running. We're not going to get the employment data until the government's back up and running. And those are the two biggest things that are driving the Federal Reserve's decisions, which means the interest rate market is now making decisions without knowing the real truth of what's happening. And it's causing mortgage rates to be in flux. We're seeing, I use a good example, my California Dream for All program that a lot of my clients are utilizing, a lot of my viewers understand and are interested in that program. We've seen the interest rate on that jump around. Today, 6.125. Yesterday, 6.5. The day before, 6.125. That's a huge swing. Almost a 0.5% swing up and then right back down in 2 days. That's not how the market should operate. That's not stability. And that makes it hard for buyers to decide, okay, now it's time for me to move forward. But I can't decide that it's time to move forward because, well, I'm only qualified if rates are at 6.125, but if they're at 6.5, I don't qualify, or I'm unwilling to buy. Well, then how can you commit to a home search when rates are jumping around that much? That's the challenge that we're dealing with right now. And that makes the market feel uncertain. I'm using the word transition. The truth is we've been in a seller's market for the last, honestly, for the last 5 years. Ever since COVID started, we've been in a seller's market. Sellers have been in control. Buyers, there's been fewer sellers than buyers. And therefore, the buyers really did not have any negotiating power. It's been shifting. We've been in transition. Buyers, right, in the last few months, really since July, buyers have had an upper hand. In some markets, I see that shifting back. I talked about this last week. But I'm also seeing in lots of other markets that it is still very, very much a buyer's market. And so you're really in a transition and you're saying, I don't know which direction is up. I don't know whether interest rates are going up. I don't know if interest rates are going down. I don't know if house prices are going up or if house prices are going down. I don't know if my job is stable or my job is unstable. There are so many things that are in flux right now, and it really is driving the market a few different directions. So the first thing is, what do you do in uncertain times? Well, what has happened in uncertain times in the past, as we look back on it, it's been the best opportunities ever. I look back at the stock market back in April. Tariffs were here. Tariffs were just being introduced. The stock market goes down significantly. I said to my wife, we should buy. Uncertain times, we should buy. Well, I got busy with mortgages and life and all the rest of that stuff, and I didn't buy any of the stocks that I wanted to buy. And now they're up significantly. And I'm like, man, I should have bought. But you don't know, in the time of uncertainty, we make decisions out of fear. We make decisions out of, well, I don't know if I want to buy those stocks because what if they go down even further tomorrow? So what? I look back now and say, man, I wish I had bought them back in April because they're up significantly and I didn't make that decision. Now, I own some of those stocks, so I've seen the up and down, but the idea is buy more when it's low. Well, the housing market's not that simple. You can't buy more. You can if you're an investor buying multiple properties. But in general, most people aren't buying more when the housing market falls. But your timing can't be perfect. And so you have to make the decision based on what timing works for you. The same holds true when it comes to rates. Whether you are buying or you're a current homeowner refinancing or thinking of selling and buying something else, you can't time the rate market. You can't play the game saying, I'm going to wait until rates drop. Because if you wait until rates drop, then prices will be moving up at that time. Now you might say, John, I already own a home. I don't really care if prices move up because I have a home already that I'm selling and that'll just raise the price of that home. In a way, that's true. In a way, it's not. At least in California, your taxes are based on what you bought the house for. So you ideally want to get the house at the lowest price possible, even if that means you're selling your prior home at a lower price because you're locking in a lower starting tax basis. So there's some moving parts here that are critical as we look at the markets and how to act during uncertain times. But I'll repeat what I said a minute ago. When I look back at all of the uncertain times in real estate, the biggest uncertain time was 2008 to 2011. You look back now, that was an amazing time to buy a home. The next most uncertain time was when COVID first hit. So March of 2020, COVID hits and oh my gosh, the housing market's going to crash. We're being in a lockdown. Nobody's going to be able to buy a home. Well, instead, everybody started working from home and they wanted to move. They wanted to buy bigger homes. They wanted to get a second home. They wanted to live out in the countryside. They wanted to live in the mountains. They wanted to go away from the big city. And it created, and rates fell. Rates fell a whole lot. And so it created a huge amount of demand and housing prices went up. And if you could have bought a home during March or April of 2020, that was the best time to buy a home because interest rates fell significantly in March. You had an opportunity to lock in a low interest rate and you didn't have a lot of competition. That ended in May. Because by May of 2020, prices were moving up significantly and they kept going for the next 2 years. And so if you operate off of fear, if you think like the average person thinks emotionally, you would say, well, it's March of 2020 and yeah, rates have dropped, but they might drop further. I'll wait. And then April of 2020, well, rates are dropped and housing prices have dropped, but they might drop further. I'll wait. And then in May, prices go up and you're like, oh, well, prices went up, but that's just temporary. I'm going to wait until prices come back down. If they only go back to where they were in April, I would have bought in April because now you recognize the bottom and now you want the bottom again. And you've built that bias in your mind. The same happens when I'm locking interest rates for people. And I have clients who say, hey, John, I'm not sure if I want to lock an interest rate. I have had clients in the last few days on rates where it's like, hey, we were down, then we were up, and then we're down. Well, I'm not sure I want to wait. Now the rate falls to what they wanted it to be. They're like, well, yeah, but it's been falling. And so I think I want to wait until it falls further. And I always ask the question, what are you waiting for? And the answer is, well, I don't know. I don't want to pay more than I have to. But every time somebody has that mentality, they end up paying more than they have to because you don't make the decision to pull the trigger until rates have gone up higher than where you wanted them to be. Because when they fall to the bottom, hear me, when they fall down. So if you said, hey, I'll buy it. If the rates are at 6%, I'll lock. And so rates go from 6.25 to 6 as an example. You're like, oh, well, I know I said I'd lock at 6, but man, they just fell 0.25% yesterday. They might fall further. And so you wait and they don't, they go back to 6.25. You're like, yeah, I'm going to lock when it gets to 6. I should have locked yesterday. Yeah, you should have. But again, you got greedy. And that's okay. That's human nature. That's fear of missing out on something better. And so then it's 6.25. And you say, okay, I'll lock when it gets to 6. And then it goes to 6.375. You're like, oh my God, I should have locked yesterday when it was at 6.25. Man, if it just gets back to 6.25, I'll lock. And then it goes to 6.5. And then you're freaking out because 6.5 is the highest rate you're willing to spend in a monthly payment. You're like, oh my God, if it goes any higher, I can't afford the payment. I can't risk this anymore. I'm getting off the roller coaster. I'm locking at 6.5. You could have locked at 6. By the way, the day after you lock, it goes back to 6.25. It's Murphy's Law. It happens every single time. That's okay. But the truth is you're never going to time it perfectly. You can never know what tomorrow is going to bring. You have to make the decision based on what you know today and make the best decision based on the information at hand and not hope or wonder that something better will come along tomorrow. That applies to almost everything in life. Make the best decision you can based on the information you have at your fingertips today and not hope that something better is going to come along tomorrow. What if tomorrow never comes? I'm just going to start singing a Garth Brooks song, but I can't sing, so you'll be thankful I'm not singing it. But the point is, you've got to be very, very cautious when you play that game. All right, so what happens now? What happens now is that, look, interest rates are in a major flux in large part because, like I've said, the market doesn't know how to react if it doesn't have the data. Housing feels unstable. Why? Because you're looking around and you're saying, well, some indicators say this and some indicators say that, and you don't know what to believe. And so in those times, close out what you're focused on. Focus on what do you see in front of you? What is the right move for you? What is your future? What is your immediate future call for? What is your economic outlook? What does your income and ability to spend and future income prospects look like? All of those pieces are what you need to be focused on. Wipe away the noise. Get rid of all the external factors that are telling you this is the right thing to do or that is the right thing to do. If I listen to Dave Ramsey, I should do this. If I listen to Susie Orman, I should do that. Listen to John King, which is don't listen to any of us. Listen to yourself. Look at what your personal economic situation is and make the right decision for you. Because as I said earlier, in uncertain times, it creates huge opportunities. So what's next for mortgages this year? Look, well, a big part's going to have to do with how long is this government shutdown lasting. The shutdown itself is not impacting mortgages very much. There are some impacts. USDA, you can't really get a USDA loan right now. Now, there aren't many USDA loans being done, but that's a pretty big impact for people who are doing USDA. The federal government, I've heard mixed answers as to whether the IRS is giving tax transcripts. Most loan programs don't require us to get a transcript of your tax returns, but some do. And it is my understanding that the IRS is not providing tax transcripts, so that can create some issues. But again, in a lot of cases, you can log onto the IRS website and pull your own transcript, and we can find a different way to validate the information. So in general, it's not, the sky is not falling. It's not falling. It's not the big deal people are making it out to be with the shutdown, but it's the uncertainty. And more importantly, it's how's this going to play out for the Fed. The Fed's supposed to meet now in 3 weeks. And in that meeting, are they going to have more data or are they not? Because there's no major important data that's been released since their last meeting. And if the shutdown lasts a month, then we're in trouble because the Fed's going to be making decisions off of emotion, not on logic. And the Fed's emotion says they're afraid of what they did back in 2022. They're afraid of underestimating inflation. And they're afraid of letting it get out of control by saying, no, we think it's going to be fine. And let's not worry about keeping rates high or raising rates. 2022, their mistake was they didn't raise rates. Right now, they should be lowering rates. But their fear is to repeat what they just did. The other fear is to look like Donald Trump won. Okay, Jerome Powell and Donald Trump are in a fight, and Jerome Powell cannot let Donald Trump look like he won because that will impact the independence, or at least the perception of independence of the Federal Reserve. And so you got kind of a stalemate going on right now, and the Federal Reserve can lower interest rates if they can point to economic reports that say, hey, we do see that employment is becoming a bigger and bigger problem. That's what they said 3 weeks ago. If they have the reports, they can say that, and they can lower rates without making it look like they did it just because the president of the United States is pressuring them to do it. But without those reports, they're stuck because they can't just say, oh, I've changed my mind now. I think something different, even though I have no new data. So this shutdown can create major havoc for interest rates for the rest of the year. Now, the question is, what's going to happen in the housing market in 2026? So fourth quarter is where I start kind of looking at next year and seeing what's happening. Fannie Mae just came out and said they expect rates to be below 6% or fall to below 6% in 2026. That's great. That'll open up a few more buyers wanting to buy, a few more sellers wanting to sell. That's not a huge difference in your monthly payment. If people are sitting here right now saying, John, I'm going to wait until 2026 now because rates are below 6. We're in the low to mid 6s right now. And you have less competition, more opportunity right now. I have people saying, John, should I wait until spring because there'll be more houses on the market in spring? Maybe, but how many other buyers are thinking exactly what you're thinking? I believe that there's an opportunity when you have a seller who's selling a house between Thanksgiving and Christmas. They really want to sell because most people don't want to have strangers walking through their house during the holidays. So somebody who has their house listed on the market during that time, they really want to sell. That might be a golden opportunity for you to get an offer on a home at a deal that you couldn't get any other time. But then again, maybe a lot of people are waiting and hearing me and using that strategy, and you're going to miss out on an opportunity because you waited until Thanksgiving because you said, John told me to go buy something between Thanksgiving and Christmas. So truth be told, stop trying to predict the future and make decisions today based on what is best for you today and what you know to be true today. And if it works, work it. If it doesn't work, don't. That is the best advice that I can absolutely give. I see 2026 continuing this uncertainty. I see 2026. I do agree. We're going to see interest rates come down a little bit more as my projection, but not to the numbers that's going to make a big difference to people. Not to the numbers that says, oh my gosh, now I can sell my house at 3% and get a new one at 4%. It's not going to happen. I don't see us being in the 4% range because there's too much turmoil and uncertainty. And the biggest wild card is going to be what's the Fed going to, who's going to be the new person running the Federal Reserve and what is their thinking going to be? And the challenge right now is that the president is trying to appoint people to lots of different areas, lots of different positions. One of the positions right now that he's trying to appoint is somebody to run the Bureau of Labor and Statistics. That's the group that puts out the report once a month for unemployment, puts out the reports for inflation. And he fired the head of the Bureau of Labor Statistics back at the beginning of August. And he had somebody else he was trying to appoint to be the head of the BLS. And this week he pulled back that appointment and said, nope, I don't want that person to run it anymore. Now, I don't know what the story is behind it. I didn't bother reading it that far. My apologies. But the truth is, Donald Trump is in charge of appointing the president of the Federal Reserve. And he's struggling sometimes with who he's appointing. Now, maybe it's because he doesn't think they're going to make it through approval with Congress. I don't know. But what I do know is that who runs the Federal Reserve next year is going to create a major impact to where interest rates are and where the housing market goes, not because they control mortgage rates, but because they influence the markets and they influence the economy. The Federal Reserve has levers they can pull that can make the economy turn one direction or another. They just have to decide which levers to pull, and they're supposed to do that in the interest of their two most important mandates. And we learned a couple of weeks ago that there's actually a third mandate, but their two mandates are to keep inflation stable, prices stable. That doesn't mean fixed or flat. It means that some inflation is good. But their second thing is to keep people fully employed. And inflation's been the only thing they've been focused on for the last 3 years. Now they're realizing, hey, unemployment is growing to be a bigger problem. Job creation isn't happening anymore. And we might hit a position where we start losing jobs. And that's a concern. The Federal Reserve can pull a lever and say, okay, I want to spur growth. I want to spur spending. And that will drive interest rates down. And that will drive housing prices up. But it all depends on who's running the Federal Reserve and what levers they are pulling that affect the economy. And then that in turn affects mortgage rates and the housing market. So we have a very volatile 2026 in front of us. First, we've got to get through the end of 2025. So I am here to help answer your questions. I'm here to help guide you. I am interviewing for the job to be your lender. Scan this QR code right up here. If you have any opportunity to need my services, I would be honored to interview for that job. You can scan the link, download my app, click the button in there to schedule a meeting. I really, really appreciate you all listening. If you have any questions, feel free to post them right now. If you're watching recorded or you come up with a question later, come back, post the question, reach out to me. I really, really appreciate the opportunity to serve you. Hope everybody has an absolutely wonderful weekend and happy start to the fourth quarter. We'll talk to y'all soon. Bye-bye.